results really keeping the markets busy. So let's get into those that were released after the close yesterday. We saw Kengen seeing first half net profit falling back close on 20%. What did you make of the numbers there?
For Kengen, their major problem last year was their hydro component, which is normally a cheap source of electricity, which they mark up and make a profit on it. And they ended up most part of the year last year using thermal energy, which is expensive because they have to have that fuel component. And unlike them, they really can't recover that fuel cost on their side. So you find that that aspect really hurt their margins, and it trickled down to the bottom line.
Well, of course, moving forward, I mean, I was speaking to the MD of Kengen earlier this week during Power Lunch, and he certainly sounds optimistic about the road ahead. What's your view on the company's prospects moving forward?
They raised enough money from the bond. I'm sure there's a couple of capex expenditure they will do this year. But it all goes down to where they're going to invest that money. If they invest it in more thermal power stations, really the year may be good for some time, but the cost will keep on hitting them as fuel prices internationally are also going up. So it's actually how they're going to use the money they got from the bond, literally on the ground, how it's going to determine how the company is going to do this year.
Of course, when I was speaking to the CEO, he was saying that, of course, they are exploring diversifying their energy sources. So that one prospect and new revenue streams to consider. Another is that the company signed this 828 million shilling infrastructure sharing agreement with 3 of Kenya's telecom operators. I mean, that should be adding significantly to the bottom line. What are you making of this diversification strategy that the company currently has at play?
We will basically have to see how the companies get, because there's a bit of confusion there on who's getting the major share of that, the fiber lines that are being played on along the cable lines. Is it going to go to KPLC? Is it going to go to Kengen? Because KPLC also are claiming a stake to those revenues. So until maybe we get some clarification, we'll be able to note that, okay, this is a significant portion that will come into their income, and pretty much at a low cost.
In the meantime, we had East African Cables out with full-year results for the 2009 period, with operating profits declining 36%. Net profits boosted, though, by a re-evaluation in the property, plant and equipment categories. That up 26.5% year-on-year. Market reaction to those numbers this morning?
Still a bit of not much activity on cables. It's a stock that doesn't really trade that much. It's kept by a close few investors, and it's a more of a derivative stock of KPLC and Kengen. If the latter and then the former do suffer in any way, they are the largest consumers of East Africa Cables goods. Then also input cost, as we saw copper prices rocketing most part of last year, which gave them an issue with their expenses.
Well, certainly on that hand, where we had East African Cables seeing operating profits declining 36%. On a more positive note, Bamburi Cement managing to grow their operating profit 30% as a result of improved distribution system and cost containment initiatives. How are you rating Bamburi when it comes to the cement players in Kenya at the moment?
Bamburi has always been a market leader, and it will always be a market leader. Their business is more mature, their customers are more reliable, and they have a strategy taking them forward. On their results for last year, if we remove the sale they did on Athi River Mining, their profits will not look that nice. Because there's a 1.5 billion that was just put on their P&L from that sale. But however, going forward, it was a business strategy. It was an investment they made, and it paid off. So going forward, I think they have their strategy in place.
Well, talking about strategy, I mean, Reginald, if you look into the detail here, I mean, we saw group turnover rising, and that was largely due to the improved export sales to inland Africa markets, and then a weakening shilling to the dollar as well. And what's highlighted is that the group maintained its selling prices in Kenya despite enormous increases that it experienced in terms of energy costs and then high inflationary pressures as well. Just how sustainable is a strategy like that for a company like this moving forward?
For a country like Kenya, where we can pretty much say we're in a housing boom for a while, and Bamburi being a major player, keeping and retaining your clients for this period is actually a very good strategy for them. I believe they have enough reserves. The cash they made last year was also went up, the cash flow, if you look at the cash flow statement. So they actually have enough money to cushion themselves against any loss they might incur because of maintaining their prices. And the nice thing about it is, as you go along and the economy improves, and because the shilling is weakened a bit, but as the economy improves, they still have the customers, and at the end of the day, your customers are your business.